There is a number that does not appear on any government dashboard. It is not tracked in real time by central banks. It is rarely discussed on cable news. It is not the number your bank manager thinks about when you walk through the door, but it moves every day, quietly, systematically. Outside the perimeter, most regulators can actually see. That number is roughly $30 trillion. It represents the global private credit market, a vast non-bank financial system that has grown alongside traditional banking for more than 15 years. It operates inside the same economy as your savings account. It influences mortgage rates, corporate hiring, pension returns, and government borrowing costs. And despite its scale, it has never undergone a full system-wide stress test. Not once. This is what happens when risk is moved into the shadows. And the shadows begin moving on their own. Act 1. What grew in the dark. To understand the present moment, you have to return to 2008. After the global financial crisis, policymakers reached a clear conclusion. Banks had taken too much risk. Governments responded with sweeping reforms. Capital requirements increased. Leverage limits tightened. Transparency rules expanded. Regulators demanded stronger balance sheets and safer lending practices. By traditional metrics, the reforms worked. Banks today hold more capital. Liquidity buffers are larger. Oversight is stricter than at any point before the crisis. But stabilizing banks did not eliminate risk. It relocated it. Businesses still needed loans. Governments still required financing. Investors still demanded returns. When banks became constrained, credit demand migrated elsewhere to hedge funds, private equity firms, insurance companies, pension funds, and investment vehicles collectively known as non-bank financial institutions. The world calls them shadow banks. In 2007, private credit markets were minor participants in global finance. By 2026, they have expanded nearly tenfold. Today, non-bank institutions control roughly half of global financial assets, approaching $239 trillion worldwide. Half. The regulated banking system is no longer the dominant force in global finance. A parallel system has emerged, less visible, less standardized, and designed to operate beyond traditional regulatory boundaries. The system became safer where regulators looked, and risk accumulated where they didn't. Act 2. The architecture of invisibility. A private credit fund operates differently from a bank. Instead of taking deposits, fund managers raise capital from institutional investors, pension funds, sovereign wealth funds, insurance companies, and university endowments. They then lend directly to companies. No bank intermediary, no public trading market. The fund itself becomes the lender. This structure serves real economic purposes. Companies that cannot access traditional bank loans gain funding. Investors earn higher returns than government bonds offer. On the surface, the system works. But 3 structural characteristics define its risk. First, leverage. Many funds borrow money to amplify returns. Leverage increases profits during stable periods, but magnifies losses when asset values decline. In an era shaped by years of cheap money, leverage accumulated gradually and largely invisibly. Second, illiquidity. Private credit loans are not traded daily. They lack transparent pricing. If investors request their money back during market stress, funds cannot easily sell assets. They must delay withdrawals or sell at steep discounts. Liquidity promises meet illiquid reality. Third, interconnectedness. Shadow institutions did not replace banks. They intertwined with them. Banks lend to private funds. Funds hold bank-issued securities. Pension funds and insurers connect both systems together. European banks now hold significant exposure to non-bank institutions. U.S. banks report similar links through lending and financing arrangements. The banking system did not detach from risk. It connected to risk through channels without windows. Risk moved into darker corners of finance, and those corners expanded. Act 3. Why nobody stopped it. The most uncomfortable truth is that this system did not grow accidentally. Everyone involved had incentives to allow it. For fund managers, private credit became extremely profitable. Illiquid assets justified higher fees. Complexity increased margins. For pension funds and insurers, the motivation was survival. After 2008, central banks pushed interest rates toward zero. Safe assets produced minimal returns. Yet retirement systems had already promised future payouts based on higher expected earnings. To meet obligations, institutional investors moved into riskier private markets. Not because they were reckless, because the alternative meant admitting the math no longer worked. Regulators faced a different problem. Non-bank institutions fell across multiple jurisdictions and legal frameworks. Effective oversight required global coordination that moved slower than financial innovation. So oversight lagged behind growth. Year after year, the system expanded. Only in 2026 did major regulators schedule the first comprehensive stress test of non-bank financial institutions. The first, after 15 years of expansion. While regulators strengthened banks through annual stress testing, half of the financial system evolved without equivalent scrutiny. Attention remained fixed on the last crisis. The next one was forming elsewhere. Act Warfare, the historical echo. In 2007, financial disclosures repeatedly included a reassuring phrase, "The exposure is manageable." It referred to mortgage-backed securities, assets that soon triggered the worst financial crisis since the Great Depression. Within 18 months, trillions in wealth vanished and unemployment surged worldwide. The same language has appeared again in recent financial reports, now describing exposure to non-bank financial institutions. History rarely repeats precisely, but it often repeats structurally. Before 2008, risk hid inside complex structured credit products. Interconnections between institutions were poorly understood until losses spread simultaneously. Today, risk resides in private credit structures managed largely outside public markets. Performance records look strong, but many managers have never navigated a deep global downturn under current leverage levels. Chains of liability run through pensions, insurers, investment funds, and banks themselves. No single regulator sees the entire network. Another parallel stands out. In 2006, banks were considered stable. Ratings agencies were confident. Economists forecast continued growth. In early 2026, global bank outlooks remain largely stable. Economic forecasts anticipate moderate expansion and cooling inflation. The banking system appears resilient. It appeared resilient in 2006 as well. The crisis did not originate inside banks. It arrived through something they were connected to. Act Phi, the fuse and the flame. Financial crises rarely begin dramatically. They start with ordinary events linked together. A market shock, rising volatility, a geopolitical escalation, a sudden interest rate move. Even modest increases in market fear can trigger capital outflows from emerging markets. When global investors withdraw funding, sovereign bond prices decline. Domestic banks holding those bonds experience losses. Government borrowing costs rise. Fiscal pressure increases. Investors attempting to exit illiquid private credit positions face limited buyers. Losses compound across institutions simultaneously. Another pathway exists through government debt markets. Large fiscal deficits require continuous issuance of new bonds. If investor confidence weakens, interest rates rise sharply. Rising rates reduce the value of existing bonds held by banks and investment funds. Balance sheets weaken, funding costs increase, lending tightens. Credit stress spreads into the real economy. Central banks model such scenarios in stress tests: falling asset prices, declining GDP, tightening liquidity, and reduced risk appetite across global markets. These variables are not hypothetical inventions. They are drawn from current global conditions. The fuse already exists. The unknown is what ignites it. Act 6. Your money in this picture. At this point, it may feel distant, a problem confined to financial institutions. It is not. If you have a pension, it likely holds exposure to private credit markets directly or indirectly. Retirement savings increasingly rely on illiquid investments seeking higher returns. If you have a mortgage, global credit conditions influence its cost. When credit tightens worldwide, borrowing becomes more expensive everywhere. If your employer carries corporate debt, that debt may be financed by private credit funds rather than banks. During stress periods, refinancing becomes harder and layoffs often follow. Deposit insurance protects bank balances from institutional failure. It does not protect employment, asset values, or economic growth. It does not prevent housing market declines when financing disappears. It does not shield pensions from falling asset prices. The shadow system performs valuable economic functions. It funds businesses and supports investment. But it also represents the largest concentration of financial risk that has never been fully tested under severe stress, and nearly everyone is connected to it through invisible financial links. Act 7, the open ending. Financial crises cannot be predicted with precision, but they leave signals. The first signal to watch is a major private credit fund restricting investor withdrawals, not collapsing, simply delaying redemptions. That indicates liquidity stress. Assets cannot be sold quickly enough to meet demand. It will likely appear as a technical announcement rather than headline news. The second signal is the outcome of the first large-scale non-bank stress tests scheduled for 2026. Pay attention not only to results, but to presentation. Strong outcomes are announced loudly. Quiet communication often reveals discomfort. The third signal lies in government bond markets, particularly U.S. Treasuries. If foreign demand weakens while debt issuance remains high, interest rates could rise sharply. Higher rates ripple through every credit market: mortgages, corporate loans, pensions, and private funds alike. None of these developments guarantee a crisis. Financial history is not a story of inevitability. It is a story of systems considered stable until interconnected risks became visible all at once. In 2007, mortgage risk moved into shadow structures, and the shadows moved back into the banking system. In 2026, a far larger pool of credit risk sits within non-bank finance. They move the risk into the dark. Now the dark is moving. The question is not whether the system functions today. It clearly does. The question is, what happens when stress finally reaches the part of the system that has never been tested, the part connected quietly to economies, pensions, governments, and households around the world? Because when it arrives, it will not feel abstract. It will arrive somewhere familiar, somewhere with a name you recognize. And when that moment comes, the story will not begin with panic. It will begin the way financial crises always begin, with a small signal few people notice, moving through the dark,